Hello, everybody. So I've been accumulating Enphase over the past few weeks, and many people in the comments section of this YouTube channel have told me, why am I buying Enphase? I should wait until 100. Many tell me it's so obvious that it's gonna go to $100, and then I should buy, right, $100. And they also tell me Q3 will be so bad. You don't realize it will be so bad. Buy stocks cheap. It's better to get them cheap. And they also assume it will be bad and get to 100 because they pretend to know the direction of the market when Enphase will report Q3. And I have a question for most people, which is how reliable really is the correlation between a stock's earnings and earnings quality and the stocks going up? Is there a relationship between the quality of the results and whether the stock goes up? Because if there was any relationship, all of the stocks that I followed this week, right? SoFi had a triple beat, stellar, stunning, really, really great, down 30% in 2 weeks. HIMS was even better than SoFi's. HIMS like literally raised guidance. The call was so insanely great. So many good things. HIMS gave exactly what the market wanted from them, which is to discuss weight loss and when weight loss drugs are coming. Exactly what the market wanted. Minus 8% in 1 day. Same story for Nubank. Same story for Milli, Mercado Libre, Milli. And Milli is perhaps the most comparable stock that really did a triple beat on all of the relevant metrics and on everything. And the stock was way down, close to 7%. So how do we know if Enphase gives a triple beat and amazing earnings? How do we know it's not gonna be down? And how do we know it will be down if they give a negative earning? Because if they give bad earnings, right? If they give negative stuff, they let us know it's doing bad. Well, maybe the market will be like, well, actually, it's not as bad as we feared, and then the stock goes up 8% or 10% because the market is like, oh, okay, well, we expect something really, really bad from Enphase, and it's pretty bad, but it's not as bad as we feared, so the stock goes up. Does that make any sense? There's no correlation. There's correlation with volatility. We know there's volatility, but if you know the direction a stock's going to go after earnings, well, good for you because I do not believe there is a way to know what's going to happen. I just don't know how the market's going to react to these things. But there's a few things that I know. And I want to go over that right now. So the first thing I know is that if Enphase reaches $100, when it reaches $100, if it reaches that, half the internet will be saying it's going to 70. And then 50 next. No matter how low a stock goes, the internet is then coming with bears telling you, oh, it's going to be even worse than that. So right now it's 130. People are coming out and saying, oh, it's going to reach 100. When it's at 100, I guarantee you, people will be saying between 70 and 50. Right? That's what they did for Tesla. If you remember Tesla in December 2022, that's what happened. Everybody was saying, oh, it's going to go to 60, 50 after it reached 100. So again, will you ever be compelled to buy? Because when it reaches 100, people will be telling you can get it at 70. Will anybody ever be compelled to buy if they wait for it to drop? Because there will always be someone louder on the internet who will say, oh, it's going to go even lower, even lower, even lower. That's the first thing that I know. That's why I don't mind buying it at 130 when people tell me it's going to reach 100. And I won't mind buying it at 100 when people tell me, oh, it's going to reach 50, right? So point number 2 is assets tend to have inertia, right? If you look at the great stocks in the history of the stock market, whether it's Philip Morris, Coca-Cola, Monster Beverage, they tend to have inertia, right? The story rarely ever stops at year 5, and really Enphase growth story is really a past 5-year type of thing, right? It really doesn't stop at year 5. Growth stories continue, and to me, Enphase is a stock whose product is just getting adopted, right? Drive around your neighborhood. How many solar roofs do you see? 5%? I bet you it's between 5 and 10%. No more. My view is 90% of the roofs will have solar eventually. I don't know if it's going to be in 2030 or in 2035, but it's going to happen because the technology makes sense. It's a technological step change. That's what solar is. Solar is a technological step change. It is free energy for your house and for your cars. For your cars, right? Because your cars are electric and they're going to be charged at home and you get it straight from the sun. And because it's a true technological change, right? Like all of the technological changes that we've had in the 20th century, this is equivalent, right? We're going to see outstanding returns, and the market is showing us this. And I want to show you this out because I'm not cherry picking any data here. So I want to show you this. This is Enphase and Tesla. The past 10 years. This is exactly 10 years, right? 8, 19, 20, 2023, 18, 2023 to 8, 19, 2013. So that's exactly 10 years. Today's the 19th for a Saturday. But, end date, of course, was Friday, yesterday. So 10 years exactly, not cherry picking, not picking anything. You can see Enphase return was about 35%, 34.97%. Tesla return, 36.30%. Enphase has been a peer of Tesla when it comes to total returns over the past 10 years. It has been a peer of Tesla. That's how powerful this company is. And if you don't trust my source, you can follow Charlie Belillo, very popular account on Twitter. And he's posted the returns over the past 5 years and the past 10 years. And you can see, depending on where you look, past 5 years it's Enphase, past 10 years in Tesla. But regardless, they're in the top 2, right? And if you want to add Solar Edge, you get into the top 3 with Solar Edge, right? Which is Enphase's quote-unquote competitor / peer, some may call, and you get NVIDIA. I mean, there is no surprise. That makes sense. There is no surprise as far as the performance goes. These are the best performing assets one can buy right now. And I believe this will continue to do so. I mean, no investment advice, right? But I believe this will continue. And I'm not chirping. It's exactly the past 10 years. It's a standard way to look at things. So that's point number 2. Point number 3 is this. I care about position sizing. Position sizing to me is more important than cost basis. Because let's say you have a stock in front of you, and you have 2 buy points. One buy point being I don't know 200, and another buy point being 100. But imagine the stock is gonna do a 50x, 50-fold. So if you buy it at 200, you made a 25-fold. If you buy it at 100, you made a 50-fold. Does that really make that much of a difference? I mean, sure, it makes a tremendous difference, but the end result is the same, is that you have an outstanding return. And what's more important, rather than nailing the 50x, what is more important is your allocation. Because if you only have 0.5% on a stock that's going to be a multi-bagger, well, that's not very good. That makes sense? That's not very good. You want to go heavy on your potential multi-baggers. I mean, we of course, talk to your financial advisor. You know everything. You know the speech of the typical YouTuber. This is not investment advice, and it depends on everything and the risk tolerance. And yes, if you're in your early 20s, you can take more concentration risk. I would argue if you're in your 30s, 40s, you have a little to lose. It's good to not go 100%, right? But still, nonetheless, going heavy to me is more important. I see this. I discuss it with my friends, for example, with Tesla. Like I know people that got better entry points in Tesla than me, but they don't have the size of a position. It's all about the size of a position. Like if you just have one share, you're just playing. Does that make sense? It's just play money. So and of course, are you going to have the strength, the will to? I don't know. I'm just gonna say a number randomly. Are you gonna have the will to put $100,000 in Enphase when it reaches 100? Probably not. But if you buy it, just a little bit, every month you just buy a little bit, you'll eventually get to positions that size and bigger than that. And that's why I think people should like, when you love a stock, when you know a stock well, you should care about position sizing. Position sizing is important. And I say this in the light, that's why I say go heavy and go light. This contrast I use in the context of the intelligent investor. And there's a famous quote in this book, old book, so written back in the old way. And he said one of the issues of the investor is that he must do something. He must be doing something, and that's the hardest thing to do, is to do nothing. And what hurts return is to do something. And one of the tricks in this book that they talk about is, if you do something, make sure that you have something to play with, right? And that's what I do. I have plenty of very, very tiny positions because I love stocks too much. I want to look at stocks. I think most of us are like that on this channel. It's what we do. We love looking at stocks, talking about stocks, debating stocks. It's important to have very tiny positions that keep you busy, but it's fun. I know what's fun, and I know what is not fun. That makes sense what I'm saying. Like, I can tell you, for example, some of the stocks I follow, I have a teeny tiny position in Figs. Figs is fun. So is LifeMD, right? So is Lovesac, the couch company that I currently know. This is fun. This is just me playing, right? Is Tesla fun? No. Tesla is not fun. Tesla is a very serious position, and it's my largest position. Bitcoin, not fun. My second biggest position. And I study these stocks, Enphase, Tesla, Bitcoin. I study them left and right in great depth, right? So there's positions to keep you busy that if they go to zero, it doesn't matter. And then there's positions that you really have a strong conviction in. And Enphase, to me, I have a very, very strong conviction in Enphase. This is not a play position. In general, when you look at my top 10 stocks that I own video, these are not play positions. These are positions that I've studied. But the investor must do something, unless you're part of a few people who are able to actually do nothing, buy a stock and move away from your brokerage account and not look at it for 5 years. And some people are like that, but if you're a passionate person about stocks, you're likely not going to be like that. So I try to distinguish the two, and it saves me from making major mistakes, because I've made major mistakes in the past. Like for example, a major mistake I made in the past was selling Bitcoin for $250 a Bitcoin. That was a major mistake. I got into Bitcoin in early 2015. And that was a major mistake, right? So anyways, you learn from your mistakes, and you learn from your assets. There's always this quote that there's a guy somewhere that I think he did a multi-bagger on Netflix, and he sold Netflix at $8. He did a multi-bagger on Netflix, selling it at $8. You think you're real smart, and now Netflix is what, $300, $400. Anyways, stocks keep their momentum. This is one important takeaway that I have for you here. Reason number 4 as to why I keep buying Enphase and Overfist is capital gains. I don't want to sell it. I don't want to sell it at 130 with the hope of buying it back at 100, because then you have to pay capital gains, right? And this is not the long-term play. This is not the long-term game. This is also why I'm always careful about covered calls or other types of options. Because again, you create taxable events with those. If you just own a stock and let it sit in the brokerage account, you're letting it compound tax-free, and you're not creating a capital gains tax event. And depend. I live in Texas, so I guess it's less problematic. But if you were to say live in California, wow, that's much more problematic for you to have capital gains. But nonetheless, we all pay the federal capital gains tax, right? Which can get as high as 20%. So it's important to not have that many capital gains. And to me, the powerful strategy is find a stock and own it. and ideally forever. And this is a teaching from Warren Buffett. I think Warren Buffett has lost its way, by the way, today. I think over the past 15 years, Warren Buffett has totally lost its way. But the earlier teachings of Buffett are very, very, very true. Like the ideal holding period is forever. That's the ideal holding period. If you look at the more than 500x time his money he did on Coca-Cola, you understand why he says he's 25% Coca-Cola. Like Warren Buffett has some real nuggets in there. And so I'm sorry to be grim. I'm going to be a little grim here. But to me, the ideal situation, this is very grim, but the ideal situation to me is to have positions that you truly, truly believe in, very, very long-term stories, long-term stocks, and you die still owning your stocks. And you pass it on to your heirs, and you do some estate planning. That's the best way to do it. Dying, still owning your stocks. And then if you want to access some of that money, well, some people will do, will sell options, all of that, write options, all that kind of stuff. But to me, it's a taxable event, so I don't really like it. To me, the better way to do it, and that's why I named the channel Beat the Denominator. Initially, when I started the channel, I thought I would make more videos about this, but I haven't gotten around to it yet. But to me, the best way to do it is you own a stock and then you borrow against it. So you borrow against stock, and you can either do it for like traditional margin, but you can also do a pledged asset line. There's plenty of banks that set it up. It's very common thing. You just borrow against your stock. You do an interest only perpetual loan against the stock, and of course the proceeds from a loan, it's a loan, so you have to pay it back. So those proceeds are obviously tax-free because you have to pay back that loan. So let's assume, I don't know, let's assume you have $1 million in Enphase and you borrow 10%, that's $100,000 of the value of a stock. You borrow that, your stock is the collateral. Well, if your $1 million in Enphase doubles to $2 million, well, all of a sudden, the $100,000 that you borrowed is only 5% of the value of a stock, isn't it? And you can probably borrow more and go back to 10%. I realize you have people who make very, very blanket statements against this type of thing. You have people who have ideological reasons to never ever do debt, and that's entirely fine. But to me, when I look at the equation of returns, you have nominator, how much money you have, and denominator, the value of the money. A way to leverage the devaluation of the money is actually to have some debt. And of course, the risk of that, and I think Nassim Nicholas Taleb really is kind of an intellectual who embodies this anti-debt sentiment, I would argue. And if you look at, say, the more popular channels like Dave Ramsey, for example, Dave Ramsey is the more popular guy who's like, no, don't ever do debt. But I think the story of being fragile versus anti-fragile is largely untrue because look at what happened in 2020, right? The government, the Fed, did not let the market crash. They did not, and that's the second time they do that. By the way, in 2008 they did the same thing. They bailed out. They bailed out the banks. They bailed out the auto. In 2020, the airlines got $45 billion. The restaurants, I don't know how much they got, but everybody got bailed out, and the what is it, apartment, real estate trusts, companies, everybody got bailed out. And same is true actually in 2023, in March 2023. The BTF P program that the Fed put in place, the $500 billion line of credit that was put in place for regional banks, that's the same thing. That's a form of QE. So there is. I mean, we are not. And if you read the Taleb books, that he's very much using history as a way to tell us, well, look, fragility is bad. You need to be anti-fragile. Don't have any debt. Prepare yourself for any scenario. Well, the truth is, I think I think anti-fragility today is not as important as it used to be because we've seen over and over again that governments are willing to do bailouts, and that's just the way it is. And even then, like even if you were to buy a stock that crashes 90% with proper asset allocation, assuming you have other assets, you can always meet a margin call. Anyways, I just don't think it's that big of a deal, and I'm not the only one who doesn't think it's that big of a deal. Let's just say if you're 90% anti-fragile and 10% fragile, the returns more than outweigh those 10% of edge cases where you wish you had been anti-fragile, if that makes any sense. It will more than outweigh that, given the fact that the odds that you're going to get bailed out if you get into the 10%, the odds are just overwhelmingly high. So anyways, sorry to ramble on this. The whole idea is that this is what billionaires do. Right? If you look at the story of Bernard Arnault and how he bought Tiffany, $15 billion, that was all it was. That was borrowing, that was monetary printing. Same for some of the margin that Elon used to buy Twitter. You know, it's same. There's a very famous story about Mark Zuckerberg in the early days. You know, he had $19 billion in 2012, and he still borrowed something like $12 million at 1% interest in order to buy his house, because he's smart, because he knows you better borrow it. So anyways, this may be a more provocative thought, but I just love the idea of letting a stock run. And you know, it's on the asset side of your personal balance sheet, and then on the liability side of your personal balance sheet, have a little debt. I don't think it's that big of a deal. Not debt advice, not investment advice, not advice. Anyways, moving on. What else do we know about Enphase? Well, we do not know. What else do we not know? We do not know when interest rates will drop. So that's what I know. I know that we don't know, and people who know that they know don't know either, or are lying, or are fooling themselves. It's like, so right now the market has turned Enphase into a single issue stock. And they say, oh, it's the interest rates, dummy. And they try to do this to Tesla, by the way, too. Like, if you remember when the market attacked Tesla, one of the things they were saying is that people are not going to finance cars at 8.99%. And they tried to turn Tesla into like a single issue stock. The only thing that matters for Tesla is interest rates. They're not going to be able to sell cars with those interest rates. And then what do we see? Tesla has no problem selling its cars. I think Enphase is going for a similar period where the market is saying, oh, people are never going to finance solar at 8.99%. And obviously, financing rates are one factor, but it's definitely not the only factor. It's absolutely not the only factor. And even if you think that was the only factor, here's the other thing. Nobody has any idea where interest rates are going. We just don't know. We just don't know. And we can't believe the chairman. It's not possible to believe the chairman or trust the chairman anymore. We can't trust that person. Remember, early 2021, not thinking about raising rates. You remember that quote? And then followed by the largest streak of rate hikes in rate history. We can't believe anything that comes out of the mouth of a chairman. It's not possible. We're not supposed to have any increases until 2024. So right now, the market is playing with probabilities, and this is the CME FedWatch tool, and right now it's telling us that rates are going to start dropping in May of 2024. It could be much sooner than that. Right, I think an analyst at Goldman Sachs said by the end of the year recently. I believe I saw that on the news. Nobody really knows. All it could take is another regional bank failure somewhere and some issue accessing the BTFP program, and boom, interest rates are dropped. I mean, we don't know. We have a political campaign that is starting. We don't know what kind of pressure will be put on the Fed with the political campaign. There's so many factors that we don't know. We have no idea where rates are headed. We have no idea. So basing an investment based on the binary outcome of are rates going to stay this high, are they going to get higher, or are they going to get lower is just pointless. Rates are just one factor that go into the adoption of solar. There's many more factors than rates. And I'm going to conclude this video with those factors. So as we said, the headwind right now is the interest rates. It's the number one headwind. This is why solar installers have a little bit of stock of the microinverters, and they have not ordered as much. And so Enphase is predicted to be flat-ish this quarter, this Q3. It's going to be flattish again, and it was surprisingly a little low in Q2. That's why the stock dropped so much. They say it's going to be flattish again in Q3, maybe in Q4. That's the headwind. The headwind is to be put in contrast with the tailwinds. And there's a lot of tailwinds for Enphase. The first tailwind is that solar gets cheaper every year. And it will eventually overcome rate increases in interest rates, right? And it's roughly. I'm gonna do take a shortcut and tell you that if you look at the long-term curves, solar gets about 10% cheaper each year. Each year, solar gets about 10% cheaper. Solar is not like a plumber or like a house or an appliance. Solar is not an appliance. It's not a washing machine, right? It's a consumer electronics good. It's the system, the solar panel. These systems, the way to understand them is they are much closer to flat screen TVs. Flat screen TVs get better every year and cheaper every year. It's the same story for solar. Solar gets better and cheaper every year. And now rates are predicted to be flat. So we're going to get into a world where we're not going to get a 10% increase in interest rates each year, even though we've had multiple 100% increases in interest rates in 1 year. But we're flat now. So we're not going to get any increases anymore in interest rates. But the technology is going to keep evolving. Technology is going to keep getting better and better and better and better. I remember into the comments, again, I love this YouTube thing. The comments, again, someone telling me, oh, we're not going to get to panels that are reaching 40% efficiency. Are you kidding me? They're already at 40% efficiency in the labs, right? Solar panels, will we have your standard size solar panel? Will that solar panel be 800 to 900 watt in 2030 compared to 400 watt today? And yes, to me, it's a clear yes. They have doubled, and there's going to be a physics. Physics is gonna be the limit. But to me, the physics is going to limit us in the 60% efficiency, not in the 40% efficiency. Right now, solar panels are at 20% efficiency. Right, so we're gonna get solar panels that are gonna get cheaper and cheaper per watt, and that are gonna produce more with fewer square foot, right? Less square footage, more energy. That's the technological trend. And it just still gets better and better and better. Yes, eventually we will reach physics, Just like if you look at Moore's Law, it seems like the physics does not allow us to make a microprocessor chip less than 3 nanometers. It seems that after 3 nanometers, we get into quantum and electrons start jumping from one conductor to the other. So 3 nanometers is the limit for semiconductors. There will be a limit for how much energy we can get out of the sun with a solar cell. But we have not reached that limit yet. We have, to me, we have 2 more doublings, at least. And well, roughly 2 more doublings. If we get to 60-ish% efficiency, let's say in 2040, that would be amazing. We're not there yet. But the point is, are we going to get 40% efficiency solar panels eventually? I believe so. I have no reason to believe we won't. And the same is true for batteries, by the way. Batteries get 10% more powerful each year. It's the same technological issue. So the economy does what it does. It has its ups and downs, but the technology after year gets even more compelling, which is why I believe everybody will have solar panels on their roofs, because it will make the most sense. Utilities raise their prices every year, making solar attractive. That's tailwind number 2. Solar is getting more attractive as utilities get all of these lawsuits, and we see very unfortunate, very sad actually, what's happened with centralization of electricity in Hawaii and the events of Hawaii. But those prices are going to go way up because of the lawsuits, because the utilities messed up, and And the utilities have to invest, and they have to invest in the grid and modernize the grid, because we see the devastation that a poorly maintained grid can do. Remember wildfires in California too, right? And that's not the only thing. So utilities are going to have to invest so much money in the grid that the prices are going to go up of electric. And so that's another tailwind. As the prices of your electric bill go up, you're more compelled to get solar and make your own electricity and be independent. The third tailwind is a tailwind that is often forgotten, even by me. I don't talk about this much. But the tailwind number 3 is independence from the grid. The grid is not always the most reliable thing. And to me, I see solar and company like Enphase, now that they have batteries, and that batteries are becoming popular, I see them as an alternative to generators. They are clearly the alternative to generators. And if you look at Generac, you may know Generac. It's these very loud generators that whenever there's a power outage, they're gas powered and they'll power your home. To me, that business is going away. And it is getting replaced with batteries. Either standby batteries, either batteries with solar, they're getting replaced with batteries. And that's still a big business. Still a mega trend. When you have power outage, how many freezers of food spoiled does it take you to decide to get a generator or to get a battery, right? My guess is one freezer of spoiled food will do the trick for most families, and so that's another big deal. People want to be sure that they are independent from the grid if anything were to happen, especially in more spread out areas. So if you're in Europe, you may be less familiar to that, but if you're in the U.S., homes are very spread out. If there is an issue, sometimes it takes days for the utility company to come back and give you your power back, because it's not like Europe where the homes are all next to each other. In the U.S., it's it's very, very big, so the homes are so far up. Anyways, okay, moving on to another tailwind is a $7,500 tax credit. That's a major tailwind. That tailwind is still going to be there. It's still going to be $7,500, but remember, the prices are going down. The costs are going up, and this tax credit remains the same. And also Enphase, although right now Enphase is more focused on buybacks and making profits, Enphase is going to have a bunch of cost of goods sold for their microinverters covered by that 11 cents credit per watt. And remember, they're releasing a 580 watt microinverter to take advantage of this 11 cents per watt. So if you really calculate, I've calculated that incentive is going to cover 80%. 80% of their cost of goods sold are going to be paid for by the government, which is insane, and I'm with Elon Musk on this. The IRA. Elon Musk said the IRA was a waste of money, and that it would hurt the taxpayer, hurt the deficit more than anything, and that it's not needed. And I agree with that. I don't think it was needed. Now, as a Enphase shareholder, I'm very happy about it. But we're gonna get into a ridiculous situation where we may get a company like Enphase who could, if they wanted to, have 80% gross margins on hardware, if they wanted to. I don't think they're gonna do it like that. But nonetheless, I mean, it's a major tailwind. People will realize in a few years how foolish 11 cents per watt is, especially as this scales, right? This type of manufacturing is gonna scale. You're still gonna unleash economies of scale as Enphase goes towards their number of 10 million produced in the US. So, anyways, moving on. What's another tailwind? Electric cars are a big tailwind for solar, and this is what we call, in innovation in general, convergence. There's a convergence of two technologies. If you get an electric car, getting solar on your roof is going to be extremely compelling, Because let me tell you the story of electric cars, and this is the main reason why EVs are getting adopted in general. And this is also true for a Chevy Volt. Like, it doesn't have to be a Tesla. It could be a Chevy Bolt, and that would be true. Is roughly, and this is, this depends where you live. Like, okay, in Texas, that's not exactly that. But in California, that's actually more expensive than that to fuel gas. It depends where you live. In my area, electric vehicles are only about 7 times cheaper here in Texas. But I know in California it's 13 times cheaper. But in a nutshell, if I average it, an electric vehicle, roughly, if you buy electricity from the grid and you want to charge it for 350 miles, that's going to be $7. An SUV, so the Model Y, right, but the gas version of the Model Y, if you want to fuel it for 350 miles, it's going to be $70. So it's 10x. It's 10 times cheaper, 0 to 1 move. People will adopt the product for something that is 10 times cheaper, and nothing else matters because it's 10 times cheaper. Now, this is where I talk about convergence. Now, imagine that household who buys 2 electric cars, because why not? They are so compelling, and they are freeing up so much cash for you, especially if you drive a lot. Then you install solar on your roof. Well, then, if you install solar on your roof with features like green charging, which is more of a marketing gimmick, it really doesn't matter. Electricity is electricity. It doesn't know if it came from electrons that were excited by the sun or if it came from the grid. Electricity doesn't know where it comes from, but it's okay. Because I think this is where one of the points where Enphase's marketing is pretty clever, is the whole idea that if you have your car is sitting at home on a sunny Sunday and your car is plugged in, well, a good full day worth of sun and your car is getting charged for free, and you're good to go. So eventually charging your cars becomes free, and the cars in your household are getting charged for free thanks to the solar that hits your roof. And by free, I mean free of fuel, right? Free of that cost. Now, I'm not talking about capex. Sure, you have to invest. That's for sure. But at least you don't have to pay for the electricity, which is stunning, which is very, very, very stunning. We and that also fits, the whole deflation topic. We're entering an era of deflation. I mean, if you realize how much lower transportation is going to cost in the future, it's just mind-boggling to me. And then the last tailwind, which to me is a big one I'm beginning to study a little more, is rate arbitrage. And the market, of course, being so short-sighted, nobody's going to want to move to NEM 3, they're going to want to stay NEM 2. In a nutshell, what was NEM 2? NEM 2 was using the grid as a battery. So NEM 2 was if you have too much sun and you're not using all of the energy from the sun, you can feed it back into the grid and your meter runs backward. And then at night, when you don't have sun, right, you can just use the energy that you stored with the electric utility. You can just buy it back at the same price. So your meter runs forward. And of course, utilities went away from that. So they decided to not be in the battery for everybody business. And they decided to be in the rent-seeking business, which is not surprising, and therefore now there is literally an incentive for people to install batteries, and people will be able to resell power to the grid at peak prices. So whenever there's a high demand on the grid, you'll be able to resell your electricity, and this is where software is headed, and Enphase is working on software like that to help you manage. But this is the future to me. Imagine a world where you get a notification on your phone. It's your utility company. You're connected to the utility company, and it's a push notification. And it says, "Hi, this is your utility company. Can we drain your home battery and your EV battery down to 20% for a $400 check? Yes, no." And if you say yes, boom, your house battery's uncharged and you're reselling electricity at a very, very hefty premium to the grid. And when I say hefty, it is very hefty. If you study California, Californians were reselling electricity as high as $3 a kilowatt hour in the month of September last year. So, and September is often a big month where you can resell electricity for a lot of money. So, That's even turning your solar install and your battery install into a money making instrument. So not only a money saving instrument, but a money making instrument. Anyways, I hope this was interesting to you. I am more bullish on Enphase every day and getting more bullish every day, and I'm very happy to have Enphase as my second largest position in the stock market, and I believe this company is part of this revolution, and this revolution is meaningful. And let me conclude even by showing you once again the returns that Enphase has had, right? Almost 35% and 36% for Tesla. Not cherry picking any data, just the past 10 years, and that's just the way it is. Thank you so much for watching. This was not investment advice. This is just entertainment. I hope you were entertained. I appreciate your likes. I appreciate your subscribes. Have a wonderful day.